Okay, let's unpack this. We're diving deep today into just one key source, the earnings call transcript from Camline Fine Sciences Limited. This covers their results for the quarter and 9 months ending December 31st, 2024.
Right. And that transcript, it's basically the conversation between the company's management and, the financial analysts.
Gives us a direct line, doesn't it?
Yeah, exactly. Direct line into how they see their own business doing, where things are headed.
Absolutely. So our mission today is really to sift through all that raw data, the analyst Q&A, and pull out the most important nuggets of knowledge for you.
Find out what the key drivers were, maybe any surprises, what they really emphasized.
Yeah, get you the shortcut to understanding this company,
Yeah.
which, often tells a bigger story about global markets and business strategy.
That's the thing. Looking closely at one company, especially in their own words, can give you those aha moments.
Yeah.
You see how the big macro stuff like trade policy or currency swings actually plays out on the ground.
Hits the production lines, pricing,
Yeah.
everything. Okay, so let's jump in. The headlines. What did the CFO actually report for Q3 FY25?
Well, the unaudited results, they showed a, let's say, modest increase on the top line. Turnover went up about 2%.
Okay.
From around Rs 423 crores to roughly Rs 433.5 crores compared to the same quarter last year.
And management actually flagged that, didn't they? Saying that 2% was far better performance than maybe expected.
They did, and they pointed straight at the ongoing Chinese impact on pricing and supply, basically saying the market's still pretty tough.
Right, those headwinds. So 2% maybe feels bigger in that context.
Exactly. So yeah, a 2% gain feels, well, significant when you're fighting that. And it wasn't just sales. The margins look better too. Gross margins ticked up from 48% to 50%. And operational EBITDA, that's, the core operating profit before all the financing and tax stuff, that went from 10% to 12%.
Okay, so signs of better efficiency. Or maybe pricing power is creeping back in some spots, despite the overall pressure.
It seems like a bit of both, actually. We'll see more as we dig in. But one thing that did muddy the waters a bit on the reported bottom line, though not core ops, was foreign exchange.
The other income line. Always tricky.
Yeah. They mentioned taking some hits from Forex this quarter. Last quarter they had a gain. This quarter a loss.
Why the swing?
Just currency volatility, basically. The U.S. dollar strengthening against, local currencies where they operate or hold debt.
Right.
And it's mostly an unrealized impact, so it shows up in their finance costs on paper because of how debt or payables get revalued each quarter.
Even if the cash hasn't actually moved? Makes sense.
Right. So core operations looking better, but currency shifts add some noise to the net profit. And their average interest rate, consolidated, is running about 9.5% to 10%.
Got it. Okay, that sets the financial scene. Now let's peel back the layers, look at the specific businesses. That's where the real story is, right?
Absolutely. Let's start with vanillin, because it seems like there are some, pretty significant market shifts happening there.
Creating opportunities for them.
It really looks like it. The transcript clearly says their vanillin vertical is seeing improving sale prices.
And the main reason.
The key driver mentioned is the likely anti-dumping action on the Chinese manufacturing in the U.S.
Okay, anti-dumping. Remind us quickly.
Basically, when a country thinks imports are being sold too cheap, like below fair market value, hurting local producers, they can slap on duties, like extra taxes, to level the field.
Right, so this U.S. action, or potential action, is pushing vanillin prices up.
Seems like it. Management even said prices were improving almost daily at one point on the call. And on top of that, they've boosted their own output.
How much?
Produced around 600 metric tons this quarter, up from maybe 500 last year, same period. And the average price they got was up about 10% just from the previous quarter.
Wow, okay, a 10% jump quarter on quarter, that's quite something. And they're ramping up production at their plant in India, Dahesh.
Yes, exactly. They're aiming for about 70% capacity utilization there by the end of this fiscal year, FY25, and they're guiding towards 75% for next year, FY26.
And that utilization number is key, isn't it, for costs?
Oh, absolutely. It really impacts their cost structure. They talked about break-even points, too, which is helpful context.
What do they say?
Well, the vanillin line on its own breaks even around 40% utilization on a full cost basis. But importantly, the combined catechol and vanillin lines there need about 70% utilization to break even overall.
So hitting that 70% target
Yeah.
is really crucial for the whole plant's profitability.
Definitely. And it's a big plant for vanillin, 6,000 tons a year capacity. That could mean peak revenue of what, $60–70 million, maybe R600 cores?
And maybe even push it to 7,000 tons with some tweaks, debottlenecking.
Potentially, yeah. And the pricing, it's really feeling the effect of that U.S. preliminary anti-dumping duty, which is, get this, a massive 187%.
187%. Wow. When did that hit?
Mid-January. And that specifically made U.S. prices jump, they said, 20% plus. Overall, across all markets, they expect the vanillin price increase to settle around 10–15%.
It's interesting, though, the U.S. duty is preliminary but actually levied, whereas in Europe it's still just proposed, right? Not actually in place yet.
That's right. But even just the talk of action in Europe seems to be nudging prices there a bit higher than elsewhere.
Shows how market sentiment works,
Yeah.
anticipating policy changes.
For sure. The final decision in Europe is expected in June, so they're obviously watching that very, very closely.
In all this uncertainty, it's making them a bit cautious on locking in future sales.
Exactly. They said very little volume for Q1 of FY26 is contracted yet, especially for Europe. They want to see how these duties shake out before committing too far ahead on price and volume.
Smart move in a volatile market, I suppose, but adds some near-term unpredictability.
It does.
What about their own costs to make the stuff? Did they give any insight?
They did. Said current production cost is running about $8.50 to $9 per K. The good news, though, is they think at 100% utilization, they could shave about 10% off that. Get it below $8 per keg.
So higher utilization means more sales and lower unit costs.
Yeah.
Double benefit.
That's the goal. And they're also looking to broaden their vanillin range, right?
Yeah, offer the whole package. Methyl vanillin, which is, the standard stuff people just call vanillin, but also ethyl vanillin, and down the line, natural vanillin.
Positions them as a more complete supplier. A one-stop shop, kind of.
Makes sense. Okay, so vanillin's story is really tied to trade policy and ramping up production. What about the other big vertical, blends? How's that doing?
Blends. That's a different story, but equally positive, maybe even more consistent. They described it as a 20% growth vertical for now almost 2 to 3 years.
Wow, 20% growth consistently for several years. That's pretty strong.
It really is, and they expect that pace, or something close, to continue. They're guiding for at least 15–20% for the next few years.
And what's driving that? Is it trade stuff too?
No, not really. This seems more fundamental. It's customer acquisition in all the regions, and also just selling more to the customers they already have.
So winning new business and growing existing accounts.
Pretty much. And it's broad-based, happening across the Americas, improving in India. Quite uniform, they said.
Okay. What actually goes into these blends?
Well, about 30% of the raw materials, they make themselves captive production. Things like BHA, BHT, TBHQ.
Okay.
The other 70% they buy from third parties. Lots of different antioxidants, organic acids, over 30 different items they mentioned. So managing that supply chain is key.
And where do these blends end up? Food and animal feed mainly.
Exactly. Human food preservation is one part, and then a big focus on animal feed, poultry, dairy, swine, aqua, even pets like dogs and cats.
That sounds like a segment needing technical know-how.
Definitely. They stress the need for significant technical service, helping customers find the exact right blend for their specific application. That expertise is probably a bit of a moat for them.
Yeah, competitive advantage. What are the margins like in blends? Are they as good as aroma?
Gross margins are pretty solid, typically in the 30–35% range, maybe closer to 35%. And once they get past a certain volume threshold, the EBITDA margins can get up towards 20%.
Not bad at all.
Yeah.
Did they mention working capital? How much cash gets tied up?
Yeah, they did. About 100 to 110 days for the blends business. That covers inventory and, waiting for customers to pay, something to factor into their overall cash needs.
Okay. And there was a quick mention about Mexico and potential U.S. tariffs. Anything major there?
It came up. Some material goes from their Mexico plant to the U.S. Management basically said, look, if tariffs happen, they could supply from other places.
If they have options.
Yeah, flexibility. But they also said they don't really see tariffs as likely right now. Apparently, the situation's kind of suspended under negotiation, so not an immediate worry impacting that growth outlook for blends.
Okay, good. So blends, consistent growth engine driven by winning and growing customers. Now, let's shift gears a bit. Talk about something that's been dragging on the numbers, the discontinued operations.
Ah, yes. This was quite an important piece of the puzzle they laid out on the call. It helps explain the gap between the reported profit numbers and what management sees the core ongoing business actually generating.
Right. You mentioned the reported Q3 EBITDA was Rs 48.8 crores. Adjusting for that Forex loss, maybe Rs 53.2 crores, but management said EBITDA from continuing operations was closer to Rs 70 crores.
That's right, which implies, simple math, about Rs 17 crores of loss in that quarter came from these discontinued bits.
And the main culprit is Europe, the Italian facility.
Primarily, yes. That's where they wound down diphenol activity. The plant was actually shut, production-wise, 2 years ago.
2 years ago. But it still costed him significant money. How does that work?
Well, it's complicated. Apparently, even though production stopped, Italian law means they have to keep maintaining the site's security, some staff, utilities, basic upkeep, because there are still hazardous intermediate materials left in the system. And getting rid of those, evacuating them safely, requires local authority clearance, and it's a difficult, time-consuming process.
Wow. So they're essentially burning cash because of regulations and the hazardous nature of what's left behind.
That's pretty much it. Management put the fixed cost cash burn from Europe at around R16 crores just in this past quarter.
Ouch. Is there an end in sight?
They hope so. They expect the loss to start reducing considerably from the first quarter of FY26 as they hopefully make progress on clearing out that material.
What's the target reduction?
Annually, they think the cost drag from Italy could drop from around R55-60 crores a year, based on figures mentioned for the first 9 months, down to maybe R20-25 crores a year.
Okay, a significant improvement.
Yeah, once the material is gone and they can really rationalize costs, they think they can get there by the end of FY26, maybe even Q1 FY26. Might not even sell the factory, just keep it mothballed, shut down, but maintained minimally.
And there's China, too. A smaller loss there.
Yes, the discontinued China operation is bleeding less, maybe Rs 3-4 crores a quarter. They expect that loss to shrink next year, too.
So the big picture goal is...
The goal is clearly for the total loss from these discontinued businesses, mostly driven by Europe, to become much, much smaller by the second quarter of FY26. Getting rid of that drag is, well, a key lever for improving the overall reported profit.
Right. Fix the legacy issues while pushing growth in the core stuff. Okay, let's look at how they're strengthening things for the future. There was that acquisition, Vitafor.
Yes, Vitafor Invest NV, they bought that specifically to strengthen their position in the animal feed market. Fits right into that strong blends vertical we talked about.
How's the integration going? Are they making it work?
Management said integration is complete, and they're already seeing progress, getting product registrations filed and approved in a bunch of countries.
Like where?
Mexico, Colombia, Peru, India, the U.S., Brazil, basically allowing them to launch Vitafor's products into new territories.
And it brings you products, too.
Yeah, Vitafor had a particular farm product profile, opening up a new segment within animal nutrition for them.
What about the financials? Was Vitafor profitable when they bought it?
No, it was actually loss-making before the acquisition, but now they say it's break-even at the EBITDA level.
Okay, progress.
And they expect it to be above break-even on the bottom line, net profit, next year. And crucially, they see it contributing quite a bit to that blend's growth target.
How much?
Maybe 20-25% growth just from Vitafor in FY26, which helps underpin that overall 15-20% growth goal for the entire blends segment.
Good to see an acquisition paying off relatively quickly. Now, shifting to the overall financial structure.
Yeah.
They did a rights issue recently, right? To raise capital.
They did, yes. And apparently it got an overwhelming response. The money's in the bank.
And what are they doing with it?
Well, Rs 100 crores went out the door pretty much immediately to repay an NCD that's a type of corporate loan, a non-convertible debenture. They'd borrowed that the previous quarter, likely to ease liquidity.
Okay, so using the fresh equity to pay down debt they took on short term. Makes sense.
Exactly. Then there's another Rs 68 crores earmarked for future debt repayment, and about Rs 56 crores left for general corporate purposes.
So where does that leave their total debt now?
Gross debt is back down to around Rs 600 crores, which is roughly where it was back in September before they took on that NCD, except, of course, for the specific loan they took for the Vitafor acquisition.
Okay. And are they planning to pay down more debt?
Yeah, the plan is regular annual repayments of around Rs 45-50 crores, so they expect gross debt to drift down towards maybe Rs 550 crores by the end of FY26.
And what about spending on new projects, new factories? CapEx.
Seems pretty contained for next year, FY26. The plan is modest, around Rs 30-35 crores. Management called it largely maintenance CapEx.
So not big expansion spending plan right now.
Doesn't sound like it. Suggests the focus is really on optimizing what they have, driving growth from the current assets, and integrating Vita4 properly.
Okay, so looking ahead, if we pull all these threads together,
Yeah.
what are the absolute core focus areas for Camline Fine Sciences now?
It seems really clear they're doubling down on three main areas. Blends, aroma, which is mostly vanillin right now, and then finding more value-added products from their basic hydroquinone, HQ, and catechol platforms.
Blends is the high-priority growth engine, sounds like.
Definitely. And in aroma, the goal is becoming that complete vanillin solution provider you mentioned.
Offering all the types, methyl, ethyl, natural.
Exactly. And for HQ and catechol, it's less about the basic chemicals and more about developing and scaling up specific, higher-value derivatives from them. The whole strategy seems to be about going deeper and maximizing profit within these chosen lanes.
Okay, so let's try and wrap this up. What does this all mean for you listening in? We've basically seen a specialty chemical player navigating some pretty tough global markets.
But actually showing improving operational results, better margins, higher production, especially in key areas.
And they're getting a real boost from those big shifts in international trade policy, particularly impacting vanillin pricing right now.
While at the same time, they're executing on a consistent multi-year growth plan in their blends business, which is now getting an extra kick from that Vita4 acquisition.
And crucially, perhaps, they're actively tackling those legacy issues